Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course and help to make it actionable, understandable, and clear. What a week, and therefore, what a show. We are going to be looking at a letter by Mr. Howard Marks. He has one of these famous letters that all the folks will tell you to read. I actually agree with them. And this most recent letter from this famed investor, he's the co-founder and co-chairman of Oaktree Capital Management, the largest investor in distressed securities worldwide. And he's got a big old net worth of $2.2 billion, but excellent letter that he wrote because there was no Wi-Fi on the plane that day. So maybe we should turn off our Wi-Fi's on the plane. Maybe we'll do something productive. And then I talk a little bit about why it's actually tougher to stick with index investing than we think and why that is. Then we'll end with a little bit of commentary on why the world has always been going through difficulties. It's never not been going through difficulties. And we can actually reference, there was another Howard Marks letter that's linked in this one from 2010. And in that letter, it says in 2010, it was just terrible to think about investing. Difficult. But let's start here. This is titled The Calculus of Value. And it's tempting in personal finance spaces, and particularly in the work I do, to gloss over the why. What do I mean by that? Oftentimes, folks like me, financial advisors, friends, will issue solutions that sound like this. Hey, you know what you should do? You should invest in index funds, and there's a historic rate of return, about 8%, 9%, and over a 30, 40-year period, that's really your best shot. You should do that. And for most folks, that's enough. That's all the theory they want to go. That's all, the only time in the classroom they want to spend is just give me the answer and let me go. What's the risk in simply giving the answer and going? You have what I would call an alien understanding of the concept. You are trusting that whoever gave you that lesson is right. And because you don't potentially own that solution when the storms come, you're not going to stick with it. So Mr. Marks really puts our head into the books and ensures we understand it. So I want us to listen to this because he's talking about value. So I want you to listen. Investment assets, stocks, bonds, companies, buildings. He says they have a value, which is referred to intrinsic value. It's a worth at any point in time. So whenever I say something like, oh, gee whiz, buy the index, behind that, there's actually a belief. You have to have a belief that there's value in all those companies smushed together in one exchange-traded fund product. He goes on, and this is important, the totality of an asset's fundamentals constitute its earning power, its ability to generate profits, which in turn is the source of its value. Did you catch that? There's a bit of brilliance here. The totality of an asset's fundamentals constitute its earning power. He's starting to sound a little bit like Warren Buffett, didn't he? So he thinks of assets that don't produce operating cash flow or don't have the potential to do so in the future as not having earning power. And in his mind, that makes them impossible to value objectively, analytically, or intrinsically. He then references his paper on gold. He has a 2010 paper that is also excellent called All That Glitters. But listen to that, because this is actually why this will segue into our why it's hard to own index funds. But listen, Marx is saying assets that don't produce operating cash flow, that means, hey, you have a business that's throwing off money, that you have profits, or that doesn't have the potential to do so in the future. So of course, a lot of companies will run at a loss or break even for a long period of time. But in the future, Amazon.com is a great example. They ran at a loss for years and years and years and years. But there was this incredible growth in their revenues. So there was this belief by investors that proved out to be very true, very, very true, that they would have profits. And now they do. So you could assign a value to Amazon.com even in 1996. when they were not making money. because there was a potential they could. However, and you probably hear the turn coming, if you don't have that visibility, if you can't, it's very, very difficult to value that, which is why it's, in my view, very, very, very difficult to stick with investments, assets whose value is contingent on someone else paying for it. So the old definition is, and this is what Marx says he was taught at the University of Chicago Graduate School of Business, that's a strong program. It's a very strong program. I'm not sure Texas A&M had a program in the 1960s quite that robust, so we'll excuse his absence from College Station, Texas. He says this: the right price for an asset is the discounted present value of its future cash flows of earnings. That's one of those basic definitions. I know we're in the classroom, listener, but this is actually critical. The right price for an asset. Now, what's the discount rate and how does that work? What discount rate do you assign? These are all good questions, but that's how you come to a value today that you would pay. Now, he goes in to talk about individual stocks and how he talks about General Motors, how, this investor will pay 52, this one will pay 46, this one will pay 58. What's the market doing? It's finding that equilibrium price that folks are willing to transact, and that's happening all day, every day in the stock market. Now, that valuation that's being arrived at, a bunch of participants. Now, I thought the real meat on this thing was where he says, well, what's happening now? Is the market overvalued today? That's probably what the market update listener is interested in. Is it not? I thought he had a humble approach to this question, but I get it all the time, and I ask myself that all the time. By the way, I've always been wrong on this. I perpetually think the market's overvalued. I'd say doesn't matter what year, 2012 to present, every year I thought, I think people are paying too much for this stuff. Listen to this. He says, the S&P 500 stock index is the most watched barometer of the U.S. stock market. Correct. Towards the end of last year, its forward-looking PE ratio, that's price to earnings ratio, that's how much am I willing to pay per dollar of earnings, was around 23. I'll pay $23 per dollar of earnings. That's significantly above its historical average. Does that mean it's overvalued? Now check this data out. This makes investors scared. JP Morgan published a graph showing that if you bought the S&P 500 index at 23 times the coming year's earnings per share in the period of 1987 to 2014, that's the only period where that data exists, the average annual return for the subsequent 10-year period was between +2 and -2 every single time. That's flat, listener. That means when this 23, which is what we have now, the next decade flat. So that bodes poorly. If that's truly relevant data, it bodes poorly. Well, what's happened? I think I mentioned this in last week's podcast. Well, markets are actually up. From the low point, there was all the tariff stuff early in the year. From the low point on April 8th, the S&P 500 is up 29%, putting it up 9% for the year to date. Up 9%. So what's happening? Well, a bunch of variables in investing. So we have to be so careful when we read a report. I remember, and it still affects me, particularly as a young adult and as a child, when I'd read a report by JP Morgan that showed the 1987 to 2014 period, and if the S&P 500 index was 23 times per, that means we're toast. I believed it every time. The older I get, the more I realize, it doesn't work like that. I wish it was so easy. We just knew when to turn on and off the investing meter. And he has all these reasons why, the market did better, and it's, the trade deals were cut, and therefore, it was priced in, and, AI is still looking good. But we don't know. He has other concerns. Marx does on value. I like this, though, and this is where we'll end for Mark's letter, because Mark's letter probably deserves its own episode, but I'm going to link it if you really want to. If you would be perfect, go and read the entire letter. But listen to this. if you feel there's overvaluation, what can you do? He has a great point. He says the existence of overvaluation can never be proved. And there's no reason to think the conditions discussed will mean there'll be a correction anytime. And he gives all these. You can't. This is a guy that knows a lot about investing. You can't prove that it's overvalued. You can't do it. So the question is, investor, what should we do? He has 6 DEFCON levels. DEFCON 5 is not a big deal, and it goes up to DEFCON 1, which is like, oh, this is the worst. So DEFCON 6, if you think the market's just terribly overvalued, what do? You just stop buying. Just hold cash. DEFCON 5, reduce aggressive holdings and increase defensive holdings. 4, sell off the remaining aggressive holdings. 3, trim defensive holdings as well. 2, eliminate all holdings. 1, go short. That's the belief that the market will go down. And I think he's exactly right. Listen to this. In my view, it's essentially impossible to reasonably reach the degree of certainty needed to implement InvestCon 3, 2, or 1. That means going short the market, eliminate all your holdings, or trimming your defensive holdings as well. Woo, what a relief. Now, he says he has no problem thinking it's InvestCon 5, which is just reduce aggressive holdings and increase defensive holdings, whatever. He basically says you can buy bonds. Fair. But isn't that a relief, listener? To know that Mr. Howard Marks, who knows a lot about value, knows a lot about value. He's saying, investor, Robert Hunt Financial listener, he doesn't know us yet, but it will. Fight on, pray on, we're gaining ground over here at the Market Update. Listen, he says you can't do it. Like going short, eliminating your holdings, or trimming off the table. Doesn't matter if the PE ratio is a jillion. And he talks about when he started in the 1960s, how it was like 50 to 90 in these nifty 50s, whatever. He says, can't do it. Can't be done. Don't try it. Ooh, what a relief. What a relief. So go ahead and go back and look at this letter. You'll enjoy it. If you want to keep reading, you can read his gold letter, also excellent. And now we talk about why it's hard to be an index fund investor. I want you to listen to this. This is something I thought about this week. I thought, the more I'm a financial advisor and the more I have my hammer and nail, which it's not for everybody, but for most people, it's just buy index funds. Like it's almost, as David Swinson said, it's almost always the right thing to do all the time. That's the Yale endowment chief, who's the late Yale endowment chief. His quote that I like, it's just about the right thing to do all the time. I mean, just do it. Why is it so hard to do? Because it is. The longer I do this, the less it's hard to do. And one thing that's entered my brain is there's always something doing much better than the index in any given year. There's always something doing much better than the index in any given year. Let me tell you a few. Did you know, listener, the last 12 months, gold's up 32.4% if you follow the GLD ticker. Bitcoin's up 81% if you follow the IBIT ticker. QQQ, which is an index, admittedly, but I'm saying plain vanilla indexing, it's up 16.7% over the past 12 months. And your Luddite, slow and steady, boring. VT, which is the global index, is up 13.31% in the last 12 months. So for the investor who's looking around and is trying to tell himself, maybe I should get exposure to these other places because they're doing better. And of course, that's always a possibility, and it's always permissible. I'll tell folks, I think it's totally permissible to take a 5% stake in gold, even a stake in Bitcoin if you treat it like an insurance policy, knowing it could expire worthless. It could be worth something. But it's just really tough. One of the hardest things to do. And I found who are the people that can and will just bare knuckle go with index funds. They're content not to follow their investments at all, and they derive almost no enjoyment from investing. Happy to take the boring route. It's tough to stick with the index, and yet it's ruthlessly effective. A quote I'll hear a lot, and I think it deserves more teasing out. I'll hear people say, hey, I have enough money in stocks. I don't want more in stocks. I want to diversify. And that may be true for some people. I think it's a very rare group of people, almost, very, very rare. And most of the time, there's an unhealthy conception of what the stock market is that needs further education. If someone says, I have too much money in stocks, they're saying, I have too much money in operating companies that are profitable. That's essentially what they're saying. I kind of say, huh. All right. Ironically, Warren Buffett, not an indexer, but a big fan of indexing. I believe a lot of his success is attributed to being willing to be second, third, fourth, and fifth place in any given year, but realizing that over 50 years, he'll be in first. That's tough. That's tough to do. You got to be willing to live in Omaha, work out of your closet in your house, and just essentially be an unknown until you're 65, 60. Very few folks are signing up for that ride. Very few. And I'll also say everybody's different. There are some investors who I actually want 5, 10, 50. I want a percentage of their net worth to be in something they can engage in, because I can certainly tell that is going to actually benefit them to have some capped exposure to some interesting asset class or something they enjoy engaging in. Better. Absolutely. I can bless and affirm that all day long. And as we close, an article, Faber Research says this: whatever the world is going through, it's probably been worse. And they look back, this is an August 19th article, but they look back and they say 2020 was a terrible year. But you go back and you look at how many bad years there were. The year 1349 was the peak of the Black Death, killed an estimated 75 to 200 million people in Europe, Eurasia, and North Africa. 1520 was smallpox in the U.S., killed 90% of the indigenous population in the Americas, 90%. 25 to 55 million people perished. 1918, influenza, killed an estimated 50 million across the globe. And on and on. They say that 536 AD was the worst. A volcano erupted in Iceland, dimmed the sun for 18 months, global cooling, coldest decade in 2,000 years, crop failures, mass starvations. When I read this, it made me think, maybe things aren't so bad. They then outline what it's like being born in 1900. You're born in 1900. When you're 14, World War I starts. It ends on your 18th birthday. 22 million people die. Later in the year, Spanish flu hits the planet, and it runs until you're 20. 50 million people die. When you're 29, the Great Depression begins. Unemployment hits 25%. Global GDP drops to 27%. That runs till you're 33. The country nearly collapses along with the world economy. When you turn 39, World War II starts. When you're 41, the U.S. is pulled into it. 75 million people perish in the war. Holocaust kills 6 million. 52, Korean War. 64, Vietnam War. Cuban Missile Crisis on your 62nd birthday. As you turn 75, the Vietnam War ends. That is a gauntlet. And of course, that affects our conception of the future and our level of optimism. And so we've got to get back to what we can control, because there are calamities always amongst us and always in the headlines. And you guessed it, listener, what can you control? Keeping those costs low, that investing simple, and that time horizon long, because that is what's going to give us the best shot on our investing journey. Till next week.